So are you looking for ways to earn passive returns without taking a lot of unnecessary risk? In this video, I'm going to share with you my results for investing in the Vanguard Money Market Fund with Vanguard and BestInvest, but also my investment in Lyxor Smart Overnight Return Market Fund with InvestEngine, as well as my returns from money deposited with Trading212. And stay to the very end to understand why I invest so much in money market funds and not in the wider stock market, even though I know the long-term results and returns will be lower. And if you haven't already, please like and subscribe and click on the notification bell to be advised when the next video is released. So what are money market funds? In a nutshell, a money market fund is like a special savings account that pools your money with other investors' money. This allows a fund manager to buy a variety of short-term secure investments like UK government bonds or gilts, or treasury bills, certificates of deposits, and short-term loans. It also allows for the purchase of highly rated company bonds. These investments generally mature quickly, meaning you have relatively quick access to your money, and they aim to provide returns slightly better than the typical savings account. And what are the features of money market funds? Well, liquidity. Money market funds are highly liquid, which means you can easily convert them to cash. They track the base rate. The returns on money market funds tend to track the base rate set by central banks. They have low volatility. These funds experience very little price fluctuations, making them a stable investment option. But it's also worth noting that the returns on a money market fund may not keep pace with inflation, especially in periods of low interest rates. And are they safe? Well, money market funds are considered to be a safe investment due to the high credit quality of the underlying assets. However, it's important to note that they are not risk-free. In rare cases, a money market fund may break the bug, meaning the net asset value or NAV falls below the £1, $1 per share mark. And this can happen if the fund invests in riskier assets or if there's a sudden loss of confidence in the money markets. And did you know in 2008, the Reserve Primary Fund actually broke the bug after investing in debt obligations of Lehman Brothers, which filed for bankruptcy. And this event triggered a panic in the money markets, leading to new regulations designed to enhance the stability of these funds. So in general, they're not considered as safe as cash in a bank account, particularly if the bank is backed by the government compensation scheme. Money market funds are often a good option for investors looking for a safe space to park their cash while earning modest returns, and generally, there's no limit on the investment amount that you can put into money market funds. There are some downsides and some alternatives you can consider. On the downsides, taxation. Money market funds are taxed on both income and capital gains. In contrast, gilts, UK government bonds, are not taxed on capital gains. But also you need to consider the returns you get from money market funds. While offering a better return than bank accounts, money market funds usually have lower returns than stocks or bonds for longer term. And there are some alternatives, easy access saving accounts or fixed term deposit accounts, and they offer security and a guaranteed return, but the rates may be lower than the money market funds. And another alternative is gilts in the UK, which offer tax advantages for potential capital appreciation. So what impacts the returns of money market funds? The returns on money market funds are primarily impacted by interest rate changes in the central bank's interest rates. They directly affect the yields on money market fund holdings. And fund expenses, the management fees and other expenses deducted from the fund's assets reduce the net return for investors. And currently, the things that could affect money market funds, as I record this video, inflation seems to be dropping to a relatively stable position. So central banks are likely to reduce interest rates. This could lead to a lower return from money market funds. So let's get into my position, the money market funds that I hold, how much I've invested, and the returns I'm getting from those money market funds. So I'm going to walk through each of the money market funds, but also which broker that they're with. So for instance, this one is with Vanguard. It's the Sterling short-term money market fund accumulation from Vanguard. And you can see that I've purchased £152,000, 871 of this money market fund, and the current value is £157,000. So the investment return for this fund has been 4,136, 15, To give you a view, it was purchased in May 2024. We're now going to move over to BestInvest, which is another broker I use for some ISAs. So again, it's a Vanguard Sterling short-term money market fund. In this case, though, it's an income fund because BestInvest didn't have an accumulation version of the fund at that time. I purchased this back in May 2024 also. And to see what we've earned from the money market fund from BestInvest, we need to look through all of the income statements that we've had. So I'm filtering by the money market fund, and we now have a list of the income generated from that particular fund. And when we add all the income up, it comes to £395.43. We also own another money market fund, this one with Invest Engine. It's a Lyxor, I think that's how you pronounce it, Smart Overnight Return money market fund. It was purchased in May 2024 and so far has given a return of £4,863. And finally, what I've got sitting with Trading212 in a high interest account, got £35,000 with them. Again, purchased in May 2024, and that's been paying a daily interest, which you can see flashing in front of your eyes now. And the total return from that savings has been £982.54. So if we take a moment to add all these together, we have £356,765 saved, either in money market funds or directly into the savings account with Trading212. At the moment, we're sitting at £367,142 in total. That includes the returns we've received, and the returns have totaled £10,377. The money has been invested since, it's mixed, but early May. If we said the 8th of May, then if we then round that up for the year, that would give us a total of 19,271. And as a percentage, that's a 5.4% return. A number of the money market funds are accumulation funds, so the money gets reinvested back into the fund, and of course then the compound interest works against the full fund value as opposed to the initial investment. So why do I hold so much in money market funds? So my investment strategy revolves around the concept of buckets. Bucket 1, my foundation, is all about preserving capital and ensuring I have readily accessible funds for emergencies or short-term needs. And for me, this also covers the funds I'll need for 3 years worth of spend. So money market funds perfectly embody this approach, offering a balance of stability, safety, accessibility, and returns that beat traditional banks and inflation. If you want to know a little bit more about my investment approach and the 3-bucket strategy, then there's a link above to a video I've created recently. So money market funds are a valuable tool for investors seeking a safe, liquid investment option with the potential to earn passive returns. And look, while they may not be the most exciting investment, they do play a crucial role in a well-diversified portfolio. However, it's really important to stay informed about the factors that can impact money market fund returns and be prepared to adjust your strategy, as I will, as needed. And if you found this video useful, please give a thumbs up and subscribe to my channel for more investment information and strategies. I'd also welcome a comment. I'd be really interested if you're investing in money market funds, which ones and what your experiences have been. Have a great day.